Good morning and welcome to the Global View here at Ausbiz. I'm Andrew Gagan. Great to have you with us here at Ausbiz as we begin a brand new trading week. Let's first take a look at where we finished on Friday. Global stocks rising, European equities 1% higher on the week. Gold and the US dollar continuing to climb. Now on Wall Street, the major indices are all finished strongly, with both the S&P 500 and Nasdaq gaining 1.7% for the week. The Dow close to 2% higher on the week, while the small cap Russell 2000 was the best performer, up close to 4.5%. Stocks, specifically Alphabet, fell as the US Department of Justice argued that the company is monopolising online search, calling for it to be broken up. And AI bellwether Nvidia slipped following its quarterly forecast, which disappointed some investors despite beating analyst estimates. And Tesla had a strong session. Shares in clothing retailer Gap surged after it raised its annual sales forecast and said the holiday season was off to a strong start. And Intuit fell after it projected second quarter revenue and profit below estimates. And shares of the gold miners, they rose as the bullion price crossed $2,700 an ounce for the first time in 2 weeks. Now, the health of the US consumer and retail sector will be in focus this week, with Black Friday sales signalling the start of the holiday shopping season. Walmart lifted its annual sales and profit targets last week. And ahead this week, earnings from Best Buy, Macy's and Nordstrom. Well, US consumer sentiment rose for a fourth straight month in November, driven by rising optimism among Republicans following Donald Trump's victory in the presidential election. And markets are now contemplating his nomination of prominent investor Scott Bessent as US Treasury Secretary, who is seen as an advocate for tax reform and deregulation. Meanwhile, longer-dated US Treasury yields slipped on Friday as investors assess how the policies of the Trump administration will affect the economy, while also awaiting fresh data that will offer further clues on Federal Reserve policy. The yield on the 10-year note falling to 4.1% and the 2-year up slightly at 4.37%. And this week sees the release of the monthly personal consumption expenditures price index, which is closely followed by the Fed, with the inflation gauge expected to have climbed 2.3% in October on an annual basis. Well, the US dollar index closed up 0.5% on Friday to be its highest level in 2 years, and the Aussie trading at 65.3 US cents. And Bitcoin, almost touching 100,000 US dollars over the weekend, has since come back to be close to 98,000 US dollars. On the commodities front, oil prices climbed 1% on Friday as the intensifying war in Ukraine boosted the market's geopolitical risk premium. Brent futures at $75 a barrel. Base metals, they've fallen, with copper off around 1%. Iron ore has fallen almost 2% to $100 a tonne. And gold continuing to rally, rising more than 1.5% to be up almost 6% for the past week, pushing it above $2,700 an ounce. Now, stocks specifically, just venturing across the Tasman, Air New Zealand has lowered its guidance the first half of FY25 as it's warned of ongoing aircraft shortages due to maintenance delays. Earnings before tax expected in the range of between 120 and 160 million Kiwi dollars, compared with 185 million reported in the first half of 24. The airline saying aircraft availability issues relating from global engine maintenance delays have seen up to 6 Airbus and 4 Boeing aircraft out of service for the first half of the financial year, which represents more than 16% of the fleet. And it's not expecting those issues to ease until early 26. SmartPay reporting a 67% decline in net profit to $879 million Kiwi, the Trans-Tasman payment provider, pointing to a challenging period for its customers in order to explain those interim results. And Synlait Milk increasing its forecast base milk price to $9.50 a kilogram of milk solids for the 24-25 season. That's up from $9, with Synlait saying that's as a consequence of higher global commodity prices. Well, let's get across some of those results and what we're also seeing more broadly in New Zealand. Greg Smith joining some Devon Funds. Greg, a good morning to you on this Monday. Let's actually start with some of those results I've just been through there, beginning with Air New Zealand. So obviously dealing with that aircraft maintenance issues.
Yeah, that's right. And as you say, it's 16% of their entire jet fleet, Andrew. So, yeah, it's obviously certainly material. So, yeah, that range, as you point out, 120 to 160 million. So that compares to the first half of FY24, which is 185 million. So, some way from there. And if you think of the midpoint around sort of 140 or so, yeah, significantly down on the FY24 result. And I guess the big thing as well is that they don't expect these availability issues to ease until early 2026. So it's pretty incredible, really. And yeah, it's interesting when you fly a lot over here, and yeah, the planes always seem full, but yeah, they're just sort of lacking that capacity. Interesting as well in terms of what they're saying about current trading. There were some positives there, I think. You know, early signs of a recovery in corporate travel, but no surprise that government travel demand remains subdued, and cost cutting and in the government here remains a big theme. And certainly, you go to Wellington, it's a little bit sort of an air of almost depression, really, not quite, but yeah, pretty subdued. But yeah, shares there in New Zealand actually up 2.8%. Yeah, oil prices, I suppose, are being pretty volatile as well. But yeah, perhaps sort of that talk about the corporate side, you know, seeing some green shoots has gone down well.
Taking a look at that share price, though, Greg, it just has not recovered from COVID, has it?
No, that's right. And obviously they had the yeah the capital raise, and look, it's actually interesting as well. It's sort of fallen down the ranks a little bit, and yeah, very patriotic, of course, but it's fallen down the ranks of sort of global airlines as well. You know, it used to be sort of top of the pops, but yeah, you got Emirates and the like, so it's highly competitive. You know, you've had you know, Alan Joyce talk about that in the past, and yeah, remains a very competitive market. And obviously, yeah, airlines were you know, effectively grounded, you know, during COVID, and then there was this race to try and reclaim all those lost earnings. And it's just been highly competitive. The initial sort of splurge and demand still quite strong. But yeah, those airfares are starting to moderate as well. You know, what with where we're sitting economically. So yeah, a long way back from sort of former glories. But look, it's a very well run airline in terms of management. They're very well respected. But yeah, certainly facing some pretty steep headwinds. And now, of course, we've got the oil price climbing again as well.
And elsewhere, Greg, as I mentioned there, Synlait, a positive update there. What's going on more broadly in the dairy sector?
Yeah. Yes, look, I'll get to the RBNZ in a minute, but yeah, there's a lot of challenges in our economy. But one area of the economy that is doing really well is the dairy sector, and that's great news because that has been under pressure. We've seen, you know, recent GDT auctions, and in fact, the trend generally this year has been very positive. So you've seen Fonterra have talked about that, you know, raising their forecast payout. You know, that's good for dairy farmers. We're now at a price level where a lot of dairy farmers will be in the green, so that's good news there, and that sort of flows down, of course, when you think about equipment purchases, when you think about the trickle down economic impacts. And yeah, you're quite right. So we had more good news in the dairy sector this morning. So Synlait, they've increased their forecast base milk price for 24-25 to $9.50 per kilogram of milk sold, and that's up from $9. A lot of the banks now are saying, you know, $10 is realistic, and that will be a record high, and that would be obviously very good for a key sector for us. And of course, we also had that really good news as well from A2 on Friday, and the share price there was up 18% on that, demand in China being a little bit more resilient than expected. You know, they're a top 5 brand there. They're going to pay a dividend for the first time in 20 years. Their China English label milk sales have been doing really well, and they've been doing well in Australia as well as the US with milk liquids. So yeah, lots of good news all around for the dairy sector. You've seen it from Fonterra, from A2, and now Synlait today. And yeah, good news for a key part of our economy.
Now, well, speaking of the economy, Greg, obviously it is struggling, and as a result, Reserve Bank of New Zealand this week expected to cut by another 50 basis points. I mean, it's setting itself up as being the most aggressive of the central banks in terms of the cutting cycle.
Yeah, there's a few things there though, and obviously just to recap on those. Yeah, we've got a lot of challenges here that sort of aren't being faced by some of the other central banks we're talking about. You know, so the US is growing at 3%. Yeah, we're in recession. We're in a per capita recession. We're in a recession at the headline level. We're also a bit of an anomaly in that our services sector is doing terribly. Most other countries, their service sector has been, it's been a beacon of light. So that's not doing well. Our manufacturing sector has been in contraction for 20 months, I think it is. So we're misfiring. We talk about Air New Zealand, but a lot of our engines are really misfiring, and it's only the dairy sector that's doing well. Property market, property prices are still down, and you're quite right that we're looking at going aggressive on the way down, but our central bank went really aggressive on the way up as well, and they've actually got a habit of doing this. So regardless of sort of who's at the helm, and we obviously lagged Australia. The RBA has a lot more sort of breathing space in being able to cut because it didn't go as hard on the way up. And also bring it back to two other things is why they want to might be a bit more aggressive, is that their sole remit is price stability. And while we've got some concerns in the US and Europe about inflation picking up again, and our currency is weakening, which is a factor as well. But we are looking at being around about that sort of the lower band of the RBNZ's target. So if you take that on board, there's an argument we should be at 3.75%, which is their neutral rate, or thereabouts. We're at 4.75%. So it seems pretty extreme, but there's actually a pretty easy case to make that we should be 100 basis points lower than where we are. Other point as well is that after this current meeting, the RBNZ doesn't meet again for almost 3 months.
Meanwhile, more broadly on the on equity-wise, where are you seeing the market track then, given what's going on with the economy? I mean, you just mentioned some of those results, of course. How is the local equity market looking?
So there's been some positive updates this morning. We've had a big used car sales yard company, Turners, come out with a pretty resilient result. So they're basically saying that new cars, spend on new cars is tanking, but used cars is doing quite well. So that's sort of showing up there. Another name, Kiwi Property Group, which is a big property company here. They're seeing a bit of resilience in retail, which is interesting. So look, I think the market, and I've talked a little bit, I suppose, gloomily about the RBNZ, but the market does tend to sort of look ahead of time, doesn't it? And looking perhaps ahead to the recovery next year. We've got those rate cuts that have already been. We're probably going to get another 50 basis points this week, and that's going to start to feed through to various parts of the economy. When you think the consumer, perhaps the property market, and we've got lots and lots. I think it's around about half of our mortgage population is going to be sort of resetting in the next 6 months or so.
Yep.
So it's going to be a real benefit to those rate cuts. So I think the market's reacting a little bit ahead of time. Our market has lagged, of course, the US this year, and we're unlike Australia and the Dow. We're not back at record highs, but we're not too far off. So we might see a bit of catch up, and I think a lot of it will be determined by what in that run into Christmas about what the RBNZ sort of says and does this week. I think 25 basis points would be disappointing. 50 basis points would probably be what the market is generally expecting.
Well, Greg, enjoy your week. Thanks for joining us from Devon Funds Management.
Thanks, Andrew. My pleasure.
Quick check of where we're likely to start. Looking for a positive one, in fact, to begin the week. So as you can see, SPI futures up 0.6%. Stay with us. Nadine is going to bring you the open in just a couple of minutes.